All right, so this is price action model number 12. This is a scalping model. It is 20 pips intraday trade model. And like the previous trade plan for model number 11, this is again what is considered a bread and butter type model. It's not meant to be a be-all end-all. It's one of those models where there's something to find every single day, so it's a bread and butter setup. Because it's a bread and butter setup, it is not going to have a high R multiple attached to it. That is not to say that you can't apply like 1 minute scalping and reduce it down and make it even tighter in terms of risk. But as you'll see, it's about as low as I want to go with a stop loss. Personally, my lowest is about 15 pips. But as a mentor, I'm trying to keep you around that 20 pip threshold for stop losses. The reason is it's going to take you decades to get really, really good and precise. And even when you obtain a certain degree of precision, the market is still apt to move beyond, 15 pips or 10 pips. Or don't ever subscribe to anyone telling you to use a 5 pip stop loss or a 2 pip stop loss. I just felt it was needed to be said here because there's a lot of yahoos out there that are taking my content and trying to rebrand it and showing fake trades and fake this and fake that. And they're not trading with 2 pip stop losses, because if they could do that, they would do it on TradingView and record it as it's happening, and you don't see that happening. All right, again, it's the ICT price action model number 12. It is a 20 pip per trade plan, and it's anchored on an intraday scalping model. Like every trading plan, we use the 5 stages of trade plan development. First is preparation, opportunity discovery, trade planning, trade execution, and trade management. All right, our preparation is going to be noting all medium and high impact events for the markets that you're following. We're going to study the events on the week to come and consider how the current market structure and the calendar events may suggest a specific weekly profile for that week's range. Basically, we're looking at that weekly expansion. Okay, we're trying to find which direction. Now, notice I said direction, not specific price level, not where the weekly close is going to be. We're trading inside that weekly bias that would expand more one-sided than the other. It doesn't matter if we close unchanged or even reverse intra-week. All we need for a model like this is to know which side is most likely going to expand, higher or lower relative to its weekly chart. The very next weekly candle, before it even starts trading on Sunday, where is the most likelihood of it moving? Is it moving higher or is it moving lower? That's the only thing you need. Preparation. We're going to be determining the IPTA data range of the last 20 trading days. Now, we're not needing or requiring 40 or 60 day look back, only the last 20 trading days. And again, we do not count Sundays. We're going to be noting the highest high and the lowest low in the past 20 trading days. This is your current dealing range. Inside this dealing range, we will look for the next draw on liquidity. Where is price likely to trade to next? Below which old low? Above which old high? We look for a PD array in the direction of the weekly range bias. That's what I just mentioned before going into the preparation stage of this trade plan. In other words, we're looking for most likelihood in terms of it moving and expanding on that weekly candle that's just opened on the next Sunday to come. Is it more likely to trade higher or lower? This is what we'll be using, and we're going to be targeting external range liquidity. We anticipate price to move to an order block that has a fair value gap with it. That would support our weekly bias on a day and news release found on the economic calendar for the current or next trading week. This volatility injection is what we wait for. This would be a run based on a low resistance liquidity run condition. opportunity discovery. We look for 20 pip ranges on a 15-minute chart that would enable a run to buy-side liquidity when bullish institutional order flow is present, or target the sell-side liquidity when bearish institutional order flow is present. As you can see here, this is a 15-minute time frame, and the idea is we're going to be targeting external range liquidity using the kill zones and, again, fair value gap with order block. And on a 5-minute chart, it would look like this. You have your order block, fair value gap, New York session, and running to that 15-minute old high for external range liquidity. Trade planning. When the market is poised to decline, we want to look for a convergence of both manipulation and price opposite to our trade bias at a time the economic calendar suggests a volatility injection will likely unfold. We will short 15-minute premium fair value gaps with bearish order blocks. When the market is poised to rally, we want to look for a convergence of both manipulation and price opposite to our trade bias at a time the economic calendar suggests a volatility injection will likely unfold. We will buy 15-minute discount fair value gaps plus bullish order block setups. So in other words, the order block that we're utilizing, it can occur or form outside the kill zone. But the return to the order block must be inside the kill zone of either New York or London. Okay, let me say that again. The order block can reside or be formed during the time of day that is not classically defined as an ICT kill zone. So in other words, it could be forming between 5 o'clock in the morning and 7 o'clock in the morning New York time. So that would be like in our quiet time, London lunch or something like that. We're not anticipating a lot there, but we still refer to the price action between those 2 hours, 5 o'clock and 7 o'clock. So while that is relatively quiet to us, we can refer to order blocks that exist there. Same way during the time that creates the central bank dealers range. That is not a time when we actually try to trade, but we can refer to blocks that occur or fair value gaps that occur during that time. It's not always the case that it forms, but I'm just throwing this in here as another point of reference. But the return to the fair value gap and the order block, both bearish or bullish relative to our bullish or bearish consideration using this trade plan, the return to the order block and fair value gap, that absolutely must be during an ICT kill zone. Otherwise, it's not a viable trade. Trade executions. When we are bearish, we will anticipate a 5-minute premium fair value gap coupled with a bearish order block to form on a 15-minute retracement higher. Now, before I go any further, the stage on this is based on that 15-minute time frame. That's your stage. The setup forms on the 5-minute chart, and it must occur during London Open and or New York Open kill zones. When we are bullish, we will anticipate a 5-minute discount fair value gap plus bullish order block to form on a 15-minute retracement lower during London Open and or New York Open kill zones. Short trade management. When we are entering a short, we will place a sell limit order. We will execute with our demo account. We will use the institutional order flow entry drill minus 5 pips as our entry price when using the sell limit order. When we're entering a long, we will place a buy limit order. We will execute with our demo account. We will use the institutional order flow entry drill plus 5 pips as our entry price when using the buy limit order. Again, the orders are placed relative to a 5-minute chart. So your institutional order flow entry drill price level is going to be derived from the 5-minute. When we're entering a short, we will place a sell limit order to take 20 pips as our objective on a single position. If you capture a 20 pip objective, close the order via a buy limit order and wait for another opportunity. When we're entering a long, we will place a buy limit order to take 20 pips as our objective on a single position. If you capture a 20 pip objective, close the order via sell limit order and wait for another opportunity. Long story short, we're entering on a limit, and as soon as we enter, we have our profit objective in the form of a counter limit. And the order sits there. We don't monkey around with it. We don't think about it. We don't obsessively, compulsively worry. We put the stop in, we put the limit order in for 20 pips, and we let it go. It's either going to stop you out or it's going to move to your profit objective. Stop loss management. Stop loss opens with 20 pip risk. When we are in profit 10 pips of our expected 20 pip objective, stop loss can be reduced by 10 pips. This cuts the risk in half. Worst case scenario, you get stopped out from entry at a full 20 pip stop loss. A better scenario is, as you start moving towards your 20 pip objective, if you get 10 pips locked in, you can reduce your stop loss by 10 pips. So if you do see a return on your stop, you're only going to get knocked off with half of what your initial risk was. So you want to be a little bit aggressive with this lower time frame scalping model, and this is one way you can do that. When we are in profit 15 pips of our expected 20 pip objective, stop loss can be reduced to break even. That's important. And I'll read it again. When we are in profit 15 pips of our expected 20 pip objective, stop loss can be reduced by break even. Now, why did I add this here? Well, I can tell you when I first started practicing and doing drills on 1 and 5 minute charts with a model that was very close to this one, it offered many times 12 to 15 pips, and I'd be expecting those 20, and they would return on me, and I would get stopped out with a loss. So as you move towards 10 pips in profit, the 20 pip objective that you're waiting for and your limit order to take you out of the trade, you have reduced with the paragraph above stating that if you're in 10 pips profit, which is half of what you expect to make, then you reduce the stop loss by 10 pips. So that's better than taking a full stop. But there's many times where if it can see 15 pips, it'll go 15 pips, 16 pips, and fail to expand to that 20 pip threshold and limit you out. So I don't like to be in those situations where I'm that close to profit and not in a position where I can be stopped out with break even. So I don't care about winning every time. I'm caring more about managing the risk, because that in itself will take care of the bottom line for you. Money management. Position size calculation formula. Position size equals account equity times R% divided by stop loss in pips. Position size is the amount of leverage your trade or trades assume. Account equity is the total amount in your trading account. R% is the percent of risk you are willing to take on per trade. The difference between your entry price and your stop loss is the number of pips you will use to divide the result of equity times R%. All right, in our first example of our hypothetical account equity of 10,000 US dollars, risk per trade on this model is 1% and or 10,000 times 1% or 100 US dollars. Stop required for the trade is 20 pips. In micro lots, that means every 1K leverage is 10 cents per pip. Using a model like this with 20 pips as our go-to for our standard stop loss threshold, 20 pips at 10 cents equals 2S US dollars. $100 or 1% of 10,000 divided by those same $2 equals the leverage of 50 micro lots per trade or 1% of the account equity. Always round down. In our next example, using mini lots, 10K leverage or $1 per pip, everything remaining the same, hypothetical $10,000 in our equity. using a 1% risk or 100 US dollars with a stop required for the model at 20 pips. 20 pips at $1 gives us 20 US dollars. That 20 US dollars divided into 100 or 1% of 10,000 gives us the potential to trade with 5 mini lots per trade or 1% of the account equity. Again, always rounding down. And lastly, this model and the 20 pips and 1% risk does not allow us to trade with a standard lot, so it's not applicable here. If your demo account takes a loss on a trade and it is the full R% you assumed, drop the R% by 50%. And when the loss is recovered by 50%, you are permitted to return to the maximum R% per trade. If the reduced R% trade assumes a loss, reduce the R% by 50% until the previous trade loss is recovered by 50%. If you take a series of 5 winning trades in a row, drop your R% by 50%. You are likely to assume a loss eventually, and this will build in equity leveling and reduce the likelihood of a large drawdown. You want a smooth equity curve that slopes or stair steps higher, not erratic distribution with deep declines. Okay, folks. Start backtesting. Collect multiple sample sets with this trade plan. If you're unclear about some of the process, rewatch the lessons to this price action model. I will provide sample sets, but do not rely or wait for mine. Dig into your charts and study what was provided here. This is model number 12, Algorithmic Theory and Lecture for the scalping model, and it focuses on 20 pips per trade. This one here is kind of like one of those bread and butter setups. These tend to repeat a lot. There's generally something like this every single trading day. You'll have to look through, obviously, a lot of the pairs and futures markets, but something is running out a previous day's high, okay, or previous day's low, or making an attempt to do that. Okay, so let me make sure you have that in your notes. You may expect the market to rally up to take out a previous day's high, but if it offers 20 pips before it gets to that previous day's high, that fits in this model. So I think if you've been paying attention, this is what I said before we even started the charter membership. Okay, before I even started doing price action models, I warned all of you in the recordings leading up to it that you're going to find that these models overlap. There's a lot of similar things, and your mind should be thinking, this looks similar to this, and this feels like that, and because they're all connected. Over time, how much time I don't know, but each of you, if given enough time, working with them, studying them, your mind will start seeing how all of them plug together. And it gives you like this tapestry, how they all connect. When one's doing something and when it ends, another model starts working. So there's always something that moves and gyrates between the marketplace. That's why some days when it's really nice in terms of volatility, I can go in there and I can buy and sell and move from one thing to the next, like Spider-Man, web slinging. And to a neophyte or someone that's been trading for a while and they see that in my recordings where I'm doing the executions both sides of the marketplace, getting out at the highs, getting short, going down to the lows, covering short and going long, there isn't a market environment that sees that repeat a lot. But when it does manifest itself, you can use this model for intraday web slinging. Okay, it's very fun to practice in a demo doing it, but I don't want you to think and go out there with a live account and start doing it, because none of you are right at that level yet. Don't be put off by that comment. Trust me when I tell you, especially in the market volatility we have today, in the last 18 months or 2 years or so, it's very difficult, okay, to find real nice, pristine symmetry in the marketplace. It's really short-lived when it happens. You got to get it, secure the money, and go, okay, and try not to be thinking at the end of every trade you just closed, there should be an alternative trade. Okay, that's a neophyte. That is someone that is a gambler. and someone that feels like they got to be in the market all the time because they're afraid of missing something, or they're addicted to winning, okay, or addicted to just the action alone. So this model can present a gambler a lot of problems, and you have to be careful that you don't go in here and try to abuse this one, because it's there all the time, but you have to be careful what you're doing and try not to be a gambler or an action hound or a junkie, put it that way. So this model, it's built on the daily range expansion, so you're not really relying on anything from the weekly, and all you have to do is try to figure out at the beginning of the day, is it likely to run for previous day's high or previous day's low, or expand in either one of those directions, allowing for 20 pips. Okay, so it's really an intraday model that takes advantage of volatility without bias, really, because you could really flip a quarter and heads buy, tails short, and as long as you know what you're looking for through market structure, intraday volatility, chances are you can probably find a 20 pip runner intraday and really be against the daily range expansions. I'm saying that just to get your gears turning, because there's a lot of volatility in the markets today, and sometimes it offers that in a very choppy range-bound market. And if you put too much emphasis on daily range expansion, directional bias, you could miss out on some really nice moves. And I don't want to lay that on your lap and kind of like inspire more fear of missing out, okay? But I'm speaking to the more refined you as the student, not right now, because you just completed all the models, you have all the algorithmic principles, you have the trading plans, you have the logic, and what's going to happen now is you're going to go through them and you're going to think about which one resonates the most with you. And it may create a hybrid. It might blend one or two or maybe even three of them with your own unique model. You're not limited to just this. I'm not saying that this is all ICT concepts are limited to. I wanted to give you a pretty broad spectrum of what you can do with the things that you learn here. And obviously I just gave another one on YouTube this year. And you can make it as simple as you want it to be. And today, everybody, without me even talking about what to do, they were out there going short E-mini S&P and NASDAQ, catching the fair value gap after buy-side liquidity and running to sell-side liquidity. And they're elated, much like you will be once you settle in on your own unique model. And it might be that one that I've gave to YouTube. There's nothing wrong with that. But for this little pattern here, this setup or model, this dandy here repeats a lot. And you can trade this in the morning session, and you can trade this in the afternoon session. You can be one direction in the morning and the opposite direction in the afternoon, or same direction from the morning and same direction in the afternoon, if you know your market. Okay, and there's a lot of volatility in index futures, and I think this one here, if you treat it instead of 20 pips, if you did something like 20 ticks, okay, that would be about 5 points, okay, or 5 handles in the S&P or NASDAQ. On a mini, one mini, that's $250. There's nothing wrong with that, folks. There's a lot of people that don't even make that in a day, gross, before taxes. So if you're able to get 5 handles, in a session once a day, trading one mini contract, that's awesome. Like my son literally made equivalent to 2 weeks of his income in his most recent trade on the 31st of May. And his elation was, Dad, this is really incredible. I mean, he's had bigger trades, obviously, you'll see some of his statements, but to sit down and say, okay, I only want to do one contract, try to do, what would be my weekly income, because he gets paid, I think it's called biweekly, where you get a check every 2 weeks or something like that. In other words, he gets 2 checks a month. So he has to work 2 full checks before he gets paid. And he doesn't get paid a whole lot. So equivalent to like $400 a week. And I don't pay for his gas. I don't do any of these things. And he didn't complain at all. But he's sick of his job. So we kind of use this model here and a blend of what I taught on YouTube. So for all of you asking, what is he using to run that account up? He's not using Enigma. He's just learning, folks. I mean, he really doesn't know a whole lot. And I am sitting next to him, and I'm telling him, what do you see here? And what do you see there? Am I pushing the button for him? Absolutely not. Am I trading this account for him? Absolutely not. Is he making poor decisions before he pushes the button? Yes. Am I saying something to prompt him to second guess that poor decision? Yes. Okay, so this model has a lot to do with what he does. This one right here. Because he has a very short attention span. He doesn't have a lot of experience, so he doesn't have that, oh, well, this reminds me of that other trade, or this reminds me of that one time when the market does this or that. He is just looking at old highs, old lows, fair value gaps after short-term little shifts in market structure, and it's easy for him to spot it. So I'm trying to cultivate that. You may not look at this model and see it as something that's viable for you because you want something more heartier, more beefier, something like Model 6 and 7, because you've heard me say that's closest all of these to what I actually trade like. And I want you to think about how often these little short-term moves present themselves. And if you're able to just lower your expectations and also reduce your, pressure on yourself about doing bigger trades. Okay, bigger is not necessarily better. If you can find a lot of 10-point moves in an index future, I mean, think about it. One mini, it's $500. 10 handles in one mini contract on the S&P, that's $500. If you did that 3 times, that's $1,500 a week. Do you make that a week at your job? How about if you're able to do that once a day? Say get 5 pips, or not 5 pips, but 5 handles in the morning session and 5 handles in the afternoon session. That's 10 or $500 a day, or $10,000 a month. How many of you make $10,000 a month? So when I'm looking at this model, I'm teaching it with the perspective that don't think it's just 20 pips. It might be 20 ticks in the SPOOS market, even the S&P. That would be the equivalent. So you can scale that 20 pip part of it to whatever you want it to be. Don't be afraid of saying, oh, I'm going to just try to do 10 pips in Forex. There's nothing wrong with that. You can do 5, 10 pip trades a week and make 50 pips a week. It's done. You've met your objective. Who's going to complain about that? I just think it's a lot of work. It depends on what you have in terms of your time, what you have in terms of your, what's the schedule like for you? Do you have a whole lot of time to do this? Do you want to be in front of the charts all the time? Do you look at this and not see it as stressful? Because a lot of you are going to discover that being in front of the charts, while it can be profitable, and I can make a whole lot of money if I sit in front of these charts all day long, I can do that. But it wears me out, and it's tiring, because in my mind, I'm racing to get every single price swing how I want it. So what I like to do is go into a specific time of day, and that's why I created the kill zones. So if you limit yourself to any one of these models, try to emphasize time management, because when you start getting good, you will start pushing everyone and everything away, and you'll just be wanting to be in the markets. And all of a sudden, your children will grow up and you don't know who they are. And that happened to me, literally. So if you're comfortable with trading index futures, you can use that 20 as a 20 tick, or 20 handles, or 10 handles. Okay, whatever you want it to be. Or you can use it as pips for Forex. Or it could be 20 ticks in the bond market. Okay, $31.25 each tick. Yeah, that's a good chunk of money. So if you're doing that over multiple contracts as your equity grows, you can turn this into whatever your imagination can come up with. There's no limit. But many of you are going to be in a rush to do this, because you've seen many times me take small accounts, run them up real quick at breakneck speed, And honestly, I wish I could go back in time and undo that. I wish I wouldn't have done it now, because it's made a lot of you feel like that's what's expected of you because you're my student or you've gone through this mentorship. And that is not what I want any of you to think. I don't want you to think that. Okay. Could it be a goal for some of you? Absolutely. Sure. You get in there and, go crazy, win the Robbins Cup, do something, spectacular. I would be the first cheerleader for you. I want to see it. But some of you just don't want that and you just want to make an income. Guess what? That's this one here. This one right here. It's easy. It's short term. You don't have to hold over day. The whole entire day. You don't have to hold for it. You don't have to hold overnight. No weekend trading. You're in and out just like that. Hit and run trading. Okay, that's kind of like what this is really specializing in. So really looking for the daily range expansion, and that might be just, is the next session in London going to be a session where it expands higher or lower? Or you look at London overnight, what did it do? Does it look like it wants to run continuously in the same direction that London did in New York? And that range expansion inside the daily range, okay, it doesn't need to be the full daily range. You just need the expansion inside that same daily candle. Much like we were discussing throughout the entire mentorship with these price action models, we are looking for an expansion on the weekly range, but we're not trying to pick the closing price. You know what I mean? So it's like we're looking for a flurry of action, like this little moment of excitement where it's going in a direction we are looking for, but the technicals and time and price all come together perfectly. And then we can engage. So I'm going to take you into an example here and try to walk you through something that would have been feasible with this. This is the dollar Swissy, and this is a pair I admittedly can't stand, but I know some of you in here trade it. Here is the daily chart. And looking at the daily chart here, you can see that we have a fair value gap here. We have what will be equivalent to a potential swing low forming in here. And there's been 2 up close candles. And it might want to expand up into that fair value gap. Now, I do not need, and you don't need it to actually get up there. But that's enough to build in a short-term bias going into the next trading day. And if we open below this candle's high, does it give me an opportunity to run that high and get 20 pips? As you can see, the market does, in fact, open. It trades down to an order block level here, hits it, rallies up, expands through the previous day's high. It does not get the fair value gap discount low. It does not need to do that. All right, and on the 5-minute chart here, here's the example of what this model is looking for, and it's something you've seen many, many times. It's nothing new. I'm not creating something new. I'm not reinventing the wheel of ICT. You've seen this before many times, but we have the previous day's high. You can see we swept that, and then it comes back down in to an order block here. We wait for an expansion swing. It creates it. It breaks a swing high up here. So all the structure here is broken to the upside. So we have a shift in market structure. It trades back down into the fair value gap that's created right here. This low is taken out by 1 pipette right there. Guess what that is? That is your institutional order flow entry drill. But the pattern is what? Fair value gap. So you can be a buyer there, run to the previous day's high. So if you're buying here at, we'll just say you got filled at 96.05. Worst case scenario, you got slippage, you were slow. It's just, it is what it is. 96.05 was your fill. Okay. 96.15 is 10 pips. 96.25, guess what that is? That's your 20 pips. And it doesn't even take out the relative equal highs up here. And you can leave a small portion on to see if you can catch a runner. And there you go. So this is like one of those always in your back pocket model where, if you want to do an exercise with yourself, okay, go into a random pair that you don't like to look at, a lot. And during the New York session or during the London session, open it up and do a quick exercise on what you think it's going to do, running out what direction, and then look for this pattern. And I promise you, you will be surprised how easy it is to find this just like that, because you know what you're looking for. What makes this pattern and this whole model here not as sexy is because it doesn't have central bank dealers range and Asian session range and flout. And it doesn't have any standard deviations across the chart. And it doesn't have breakers. It doesn't have all the things that you want to apply to it. It doesn't have COT. It doesn't have seasonal tendency because you want a PhD at the end of your ICT student name. PhDs are not required to be profitable in the marketplace. All you need to do is have something that works, that really resonates with your personality. And this is one of the stripped down versions of all of them. The only thing that's less than this one is what I showed on YouTube. So the most simplest one is YouTube, and then this one here. Both of them can create a career where you don't need to do anything. You don't need to look at anything else. You don't need to complicate anything. Where's it likely to draw to next? And some of you are like, well, that's the problem. If I could just know what the bias is. I've already taught you bias. The problem is you haven't done the work to practice and get good at it. And guess what? Some of you want bias to be perfectly accurate for yourself every single day. And I'm not that way either. I'm not accurate every single day. I'm requiring things to support the ideas I'm looking for. Sometimes I get it, sometimes I don't. And I know when I'm likely to get it wrong, which is non-farm payroll weeks after Wednesday, New York session. I'm probably going to get it wrong. So if I know when that's likely to occur, guess what I'm doing? I'm sparing myself the grief. I'm going to be focusing on times when I'm feeling more in tune with the marketplace and the market's more likely to give me what I'm looking for, regardless of what model I'm using. So now because you have all these models in front of you, some of you probably still feel confused. That's normal because you have to go through the work of going through each one of these models or one of them and figure out which one you want to work on. And it may build your expectations about something else that's not specifically taught in one of these models. And you might blend something from another one. And then that becomes your unique model. It's happened already, folks. I got students that have done that. Or a framework from one model, but an entry strategy in logic with another, or maybe two, and blending that together. Because all these concepts of mine, again, are like that jigsaw puzzle where they all connect. And all you need to know is this one little thing like this, where it goes here and it's probably going to go above there. You don't need to know it's going to go up there. Don't be like the yahoos over there on Instagram, Twitter, and Facebook who want to make you believe that they knew this high was going to form, or they're always doing 200 to 1 R multiple trades or 50 to 1 R multiple trades, but yet they're still showing examples where they're only trading with one micro lot. Does the math support that? No. No. So all you're looking for is these small little surgical strikes with this model. Small little get in and get out, hit and run trading. Okay? That's what I used to call it on America Online. Get in, get your money and run. And let them have all the extra you leave on the table. Who cares? This pattern repeats so many times, you don't need the full move. But you understand how to leave a runner on after taking the bulk of your trade off. So if you took this long here, and you know you're looking for this previous day's high to be taken out, but you also have these relative equal highs, 80% of your trade comes off as soon as it crosses that candle's high. One pipette, just one pipette above that, you're done. 80% of the trade comes off, bang, you roll your stop to something plus, break even. You don't want to be just at break even. You want to put something in your pocket in case it comes back against you. And let's see what it does. In this event, it goes above this high here. We'll call it 25. It's 10, 20, 30 pips. Well, you know about that, right? 10, 20, 30 pips above an old high or below an old low. There it is. That's where you can take your scaling. 80% comes off here, so that means you got 20%, right? Well, if it runs up 10 pips more, take another partial off. Let the runner go to another objective of 10 or 15 or 20. And then, or trail your stop loss underneath the candles. When they close, squeeze it up there. That's coming out of Alexander Elder's book, Trading for a Living. I did that a lot as a commodity trader, and it always used to come back and knock me out because institutional order flow entry drill that I didn't know about then, and they would take me out. and then it would continuously move up, and I'd be mad I didn't get that last 4 cents in the grain market. I missed $200, and I was mad about that. And sometimes I would get stopped out and go back in, mad because they stopped me out, not realizing that it's about to turn around and go the other direction. So anyway, I digress. I believe that you have been equipped with, in my opinion, and I'm obviously biased, but I believe I have equipped you with the absolute best in terms of technical understanding. I've given you skills and concepts that will hopefully serve you and your family exceedingly well. Will all of you become millionaires? No. Will you be better than the average person out there trading? I believe yes. But I'm biased. If you've been fumbling around through the content and not really been serious about doing it, just Netflix watching, just putting videos in and watching them and seeing what happens and thinking that's going to do it, hopefully by now you've discovered that that's not what it is. Look around. Everybody that's doing these trades and showing you examples, they're in there working really hard. They're hungry. They want to get it and learn it. And because some of you are acting all bougie, like you're in here, like this is the, there's a place down in Florida called 30A, and we frequent it a lot down here. And these people are very snobbish, like very snooty. And for the life of me, I don't understand why. Why do you think that way about themselves? But I'm walking through there. I probably got more money than all of them. And that's sometimes the attitude that my veteran students have here. Okay. It's like, well, I don't need to do that. But if you're not really doing well in the content, just because you're part of our community, you're really not doing what it is that you're supposed to be doing. So what's holding you back? You have to do it. And it might be you don't want to feel like you've done it wrong. So it just feels better to entertain yourself watching videos and keep telling yourself, oh, well, there's something that will happen. He'll teach something easy and it'll be like a push a button. It'll jump off the page and there it is. That has never happened yet, has it? The closest thing is what I've given on YouTube. That's the closest it's going to get. There's nothing else that can make it any easier than that. Like that is the limit of ICT, making it simple. I cannot make it any more plainer than that. So if none of these models here have scratched that itch, and the YouTube model hasn't scratched the itch for you, I'm tapped out, folks. Okay. There's nothing else I can do to make it happen for you. You have to put the work behind it. You got to roll your sleeves up and say, you know what? I want to get in here and do it. Because there is no other videos now. You're listening to the last one. This is the last ICT mentorship video. Anything that goes on inside of our mentorship now will be posted in the forum. That'll be posted by me as a chart. There won't be any of that tonight because you have had a number of these videos, these price action model algorithmic videos posted to the forum tonight. So you all have them now. Be downloading them, watching them or whatever, or completing the rest of your downloading. I've extended the grace period to Friday at 9 o'clock. At 9 o'clock, the forum will have only the charter member area in it. There will not be any commentary section threads. There will not be any kind of price action model threads. So you need to download these videos, folks. Okay? And put them where you feel secure in having them. And then we'll continue, obviously, on our journey together in the forum, much like it was on Baby Pips, where we all communicated, typing out things and sharing charts. Trust me, I love that because it's quick, it's easy, it's efficient, and I don't have to do all these videos anymore. And I don't want my life to be all this, okay? I want to teach, I want to enjoy teaching, but I need my time back. And you'll have your time back too. You won't be sitting and listening to these long-winded, droning on messages that you probably don't want to listen to. But for all of you that have come this far, I want to congratulate you. You have endured some of the hardest things to learn. You may not have them underneath your belt yet. You may not be proficient with all of it yet, but you have endured what many people have come into my company and started to learn, and for whatever reason, tapped out and said, I can't do it. You didn't. That deserves an applaud, because it's so easy to tap out, because it's not easy learning it. It's not easy encountering those demons that every one of us have. And these charts are mirrors. They're going to reflect back what you have inside. If you're angry, impatient, you're going to see that in these charts, and it's going to manifest in your actions. If you're scared and apprehensive, these charts are going to show that, and it's going to manifest in your trades. If you're grounded, you're not moved by emotion, you don't fear missing anything, and you're not greedy, it's going to manifest itself in your trades. And you're going to be consistently moving in the right direction with that mindset. It's been my goal, and will remain to be my goal, to have all of you get aligned with that latter mindset. However, you have to prune all those bad habits that you know what they are. When you're journaling, you keep the bad, toxic stuff out. When you're in the forum, you don't post anything negative. Not because I want sugary sweet and bubble gums and gumdrops in here, but there's a way of talking about adversity. Being all emotional about it or angry and venting. This is not where you do that. You don't do it in your journal either. Take yourself a drive and talk to yourself. Say, I need this to be handled, but then get it out of your system, but then go back to your journal and then self-talk. Cheerlead yourself. Go back into the charts and you'll see that it is therapy. Or don't. And stay exactly how you are right now. Because unless you make changes in the order of what you do, in the processes that you do, you're not going to get better at this. Because you have to take action. You have to put effort behind it. And the amount of effort that you think you've already put in, it's probably not even close to what's required for your unique experience. So are you going to quit? You're going to tap out and say, it's too hard. It didn't happen for me. I already went to the charter level, went to the last price action model. He gave us all this stuff and I don't know how to do it yet. When there's other people already doing it. So the question is why are they able to do it and you're not? They're doing something that you aren't. What is that? Continuously trying to improve. And that's all you need to do. It'll happen for you. You just got to trust the process, and it may take longer than what you originally thought. Exactly how I promised it would be. And so I'll talk to you next time in the forum, not in video. Obviously, you'll probably hear me in YouTube tomorrow night, but in the forum, we will be communicating by way of threads. The thread will be locked down for me only, so that way it won't be cluttered up, but it'll be my post, that way everyone can track what I'm doing on a day-by-day basis. And I think that's going to be it. And until I'll talk to you next time, be safe.